Welcome back to Macro Examiner, your go-to channel for macroeconomic analysis. In today's episode, we have a series of interesting charts covering options activity, mega-cap tech stocks performance, asset manager equity positioning, liquidity, and more. Let's dive into the details. Image 1 is from Goldman Sachs and shows record call volume in the S&P 500. As you can see in the chart, the call volume in SPX has skyrocketed, hitting an astounding $700 billion of notional value exchanged in a single day. This marks a new record in the market. The upward trend in call volume indicates a significant increase in bullish sentiment among investors, as more and more individuals are betting on the price of the S&P 500 index to rise. The surge in call volume suggests optimism and anticipation of further market gains. We now turn our attention to a chart focused on the Russell 2000 ETF, also known as IWM, which holds U.S. small-cap companies. Let's delve into the details. This chart, similar to the previous one, illustrates the surge in call volume, but this time in the context of the Russell 2000 ETF. Just like the S&P 500, the call volume in IWM has reached unprecedented heights, with a record notional dollar value exchanged in a single day as well. This underscores the growing confidence and bullish sentiment surrounding large and now small-cap stocks, which have underperformed in 2023, but are seeing rotation into now. Our exploration of market trends continues with Image 3, where we analyze the net call volume across different sector groups. In this chart, we can observe the net call volume across various sector groups, such as technology, defensives, energy, cyclicals, financials, and losing stocks. What immediately catches our attention is the remarkable call volume in the technology sector, represented by the green line. As you can see, the green line shoots up and to the right, indicating a massive surge in call volume for technology stocks. This heightened interest in tech companies suggests a strong bullish sentiment within the sector and on the verge of euphoria. Examining the net call volume across multiple sectors helps us gain a broader understanding of market sentiment and potential investment preferences. With artificial intelligence and ChatGPT, it is no surprise technology has seen such bullish call flows. Our next image delves into the realm of tech equity flows. In this chart, we witness the one-week tech equity flows since 2001. As of May 31, 2023, it had reached the highest level ever recorded, standing at a staggering $7.4 billion. This places it in the 100th percentile of the available data. Record high level of tech equity flows signifies a strong conviction among investors regarding the growth potential and long-term prospects of the technology sector. It reflects the belief that technology will continue to drive innovation, disrupt traditional industries, and deliver substantial returns for shareholders. Our exploration of market trends continues with this next chart, which shows the indexed returns of 3 baskets of stocks since December 2022. In this chart, we observe the performance of 3 distinct baskets of stocks since December 2022. The first basket, consisting of 7 stocks including Meta, Amazon, Apple, Microsoft, Google, Tesla, and Nvidia, has demonstrated remarkable growth. Combined, these stocks have surged by an impressive 54% since December 2022. The second basket comprises the S&P 500, which has experienced a solid 12% increase since December 2022. While this growth is notable, it is surpassed by the impressive performance of the first basket, emphasizing the substantial outperformance of large-cap tech stocks. Lastly, the third basket represents the S&P 500 index minus the 7 stocks mentioned earlier. This basket, composed of the remaining 493 stocks within the S&P 500, has seen a more modest increase of 2% since December 2022. Image 6 takes us to the trading world as we explore the intriguing chart from Bloomberg showcasing the spike in big tech call trading volume every Friday. In this chart, we observe a notable pattern emerging in the trading volume of big tech call options. As depicted, the volume has experienced a consistent spike every Friday, indicating increased activity in trading these options for the prominent technology stocks. This next graph shows U.S. semiconductors relative to global markets, year-over-year percentage change, and U.S. manufacturing new orders. The U.S. semiconductor sector plays a critical role in the global supply chain, particularly in the technology and electronics industries. As such, it serves as a key indicator of economic health and market sentiment. Credit Suisse's analysis suggests that semiconductor stocks have already priced in manufacturing new orders level of 65. indicating that the current market valuations are reflective of this anticipated level of demand. Delving into Image 8, which provides us with valuable insights into equity futures asset managers' positions. In this chart, we can observe the asset managers' positions in teal for MSCI EM, in orange for MSCI EFE, and in dark blue for the S&P 500. The chart covers the period from 2015 to the present day. Notably, we can observe a trend in asset managers reducing their exposure in 2021 and throughout 2022. This reduction in positioning signifies a cautious approach by asset managers. However, since October 2022, we have witnessed a rally in stocks, and this rally has prompted asset managers to increase their positioning due to the fear of missing out, and thus underperforming with client money. This next chart sheds light on global liquidity and its recent trends. In this chart, we can observe the trajectory of global liquidity over time. Notably, in 2022, the global liquidity impulse turned negative. However, since 2023, we have witnessed an inflection point, with the liquidity impulse experiencing an upward trend once again. This suggests that global liquidity has become more ample in recent times. The highlighted period in the chart, specifically March-April 2023, holds particular significance. During this time, a regional banking crisis unfolded, resulting in the failure of multiple regional banks. As a consequence, many of these banks had to access the Federal Reserve's lending facilities to address their liquidity needs. The expansion of the Federal Reserve's balance sheet by $400 billion during this period is a testament to the efforts made to ensure liquidity was there in the banking system. Here we are presented with the Fear and Greed Index, a measure that gauges market sentiment and investor psychology. As of the latest reading, the index stands at 75, indicating a state of extreme greed in the market. The current level of extreme greed signifies an overwhelming bullish sentiment prevailing among market participants. We've previously discussed the surge in call option volumes, the remarkable performance of tech stocks, and asset managers' underpositioning. These factors, along with the injection of liquidity into the market, have contributed to the prevailing sentiment of extreme greed. The record volumes in call options reflect the heightened speculative activity and potential bets on further market gains. Meanwhile, the outperformance of tech stocks and asset managers' increased positioning point to a concentrated focus on high-growth sectors. The injection of liquidity into the market, as we discussed earlier, has provided ample support and fueled the current market conditions. The presence of liquidity acts as a catalyst, enabling investors to pursue riskier strategies. It's important to note that extreme greed in the market can also carry risks. Investor sentiment can swiftly shift, leading to potential market corrections or increased volatility. We're now turning our attention to the next image, which importantly highlights a critical development in global liquidity that is upon us and its potential impact on capital markets. In this chart, we are confronted with a concerning trend regarding global liquidity. It reveals that global liquidity is projected to collapse by over $1 trillion in the next 3-4 months. This significant decline in liquidity stems from multiple factors at play. One crucial factor contributing to this decline is the recent raising of the debt ceiling in the United States. With the approval to refill the Treasury General Account, Janet Yellen and the Treasury Department will issue a massive influx of newly issued Treasury bills and bonds. As a result, this surge in government debt issuance will absorb liquidity from capital markets and drain bank reserves potentially, leading to less credit growth and lending. Adding to the liquidity strain, we have the Federal Reserve continuing with quantitative tightening. This process involves reducing the size of the Federal Reserve's balance sheet by unwinding its holdings of Treasury securities and mortgage-backed securities. Furthermore, the European Central Bank has also been engaged in reducing its balance sheet, further draining liquidity from the market. Our next image presents a crucial indicator of credit conditions and its potential implications for the economy. The orange line represents the year-over-year change in bank lending standards, while the gray line represents the percentage of banks tightening lending standards advanced by 12 months. The relationship between tighter lending standards and credit contraction is highlighted in this chart. As the percentage of banks tightening lending standards increases, it serves as an indication of a more cautious approach by financial institutions and a potential credit contraction in the economy. History has shown that periods of tighter lending standards have often preceded or coincided with economic recessions. The tightening of lending standards can restrict credit availability for businesses and consumers, thereby impacting consumption, investment, and overall economic activity. Chart 13 sheds light on the critical aspect of capital expenditure, CAPEX, and its implications for economic growth. In this chart, we are presented with a historical perspective on CAPEX and non-residential fixed investment, dating back to 1992. The chart highlights a concerning trend: the sharp decline in CAPEX, which has significant implications for companies and the broader economy. CAPEX refers to the investment made by businesses in new equipment, machinery, technology, and infrastructure to enhance productivity and expand their operations. It is a crucial driver of economic growth and productivity gains. The chart clearly depicts the CAPEX decline, showing that it is falling off a cliff. This downturn in CAPEX suggests that companies are scaling back their investment plans, which sets the stage for a lower growth cycle. It's important to note that CAPEX declines can have spillover effects on non-residential fixed investment, which is a significant component of the gross domestic product, GDP. The reduction in CAPEX investment pulls down the non-residential fixed investment component, impacting overall economic growth. We can observe the repercussions of this trend in the GDP numbers. For example, in the first quarter, equipment spending fell by 7.3%. This next graph from JP Morgan reveals a concerning trend in the U.S. broad money supply growth. The growth rate of the U.S. broad money supply has turned negative, signifying a contraction in liquidity within the economy. According to JP Morgan, the looming liquidity contraction, combined with recession concerns, warrants a cautious stance on risk assets. The contraction in broad liquidity within the U.S. is projected to further decline by $1.1 trillion from current levels. This anticipated contraction in broad liquidity represents one of the most significant declines since the aftermath of the Lehman crisis. Our last image presents an intriguing recession forecasting model developed by Deutsche Bank. The Deutsche Bank recession forecasting model indicates a probability of 100% for a recession occurring within the next 12 months. Deutsche Bank's forecasting model utilizes a range of economic indicators and variables to assess the likelihood of a recession. Its conclusion of a 100% probability highlights the seriousness of the situation and the potential challenges lying ahead. However, it's important to remember that economic forecasts are subject to inherent uncertainties. Thank you for joining us on this enlightening journey through the world of macroeconomics. We hope that these insights have deepened your understanding of the global economy and its impact on financial markets. We look forward to bringing you more fascinating insights in future videos. If you enjoyed this video, like, comment, and subscribe. Thanks for watching.